I'm Cormac Kinney. I'm the founder and CEO of Diamond Standard. Welcome to this weekly webinar where we talk about the Diamond Standard commodities, the investment thesis, why we think it's a good investment now and over, we think, the next several years, and answer any questions. So if you do have questions, please type them in. And at the end of this presentation, Chris will read them off to me, and we'll try to answer as many as we can in the time we have. Starting though, if you're not familiar with what we do at Diamond Standard, this is what we make. This is a Diamond Standard coin and a Diamond Standard bar. And if you look inside each of these commodities, you'll see the diamonds are inside. So every Diamond Standard coin is equivalent to every other coin. This is because inside there's a mix of diamonds that always add up to a public standard. That standard was established by an initial offering that was regulated and audited by Deloitte. And we discovered how much diamond you get per dollar, how much carat weight, color, and clarity. And now we have to replicate that every time we build coins. So a coin we make today and a coin we make in 30 years will always have that same geological content. Whether diamonds go up, diamonds go down, every coin remains equal. So they all rise and fall with the market. And what this represents is the very first time a diamond can be part of an investment portfolio, because you, for the first time, have an asset that has price discovery, has liquidity if you want to sell it. And if you're an institutional investor, you can mark to market for the very first time. And that's exactly what prevented diamonds from being an investable asset for the last 100 years. Even though diamonds are more valuable than many other precious metals, investors could never hold them because they couldn't provide that valuation. They couldn't obtain liquidity when they wanted to sell them. And our mission at Diamond Standard was to create a market-traded, regulator-approved diamond commodity that makes that trading possible for the very first time. So I think it'd be very helpful to explain how we do this. And this deck, by the way, this is available for you to download either from our website or in this application that you're using to view this, depending on which application. But if you don't have this deck, you're welcome to contact us at hello@diamondstandard.co or visit our website, and you can download this deck. So let me switch. I'm going to jump ahead in this deck to one of my favorite slides, which attempts to explain in really great detail exactly how we make these commodities. And it really starts with the physical commodity, which is very unique. It's a coin in a bar, and if you notice, the diamonds in the coin are all smaller than the diamonds in the bar. And between these two physical commodities, we can actually incorporate 94% of the varieties of gem quality diamonds. What I mean is the combination of carat weight, color, and clarity, and other factors, geological factors. Of all the possible combinations, we can use 94%. What we don't use are the large diamonds you might see at Harry Winston, 4 or 5 carat diamonds, 10 carat diamonds. We don't use blue diamonds, pink diamonds, yellow diamonds. We also don't use very small diamonds that are not economical for us to have graded and inspected by third parties. They're not valuable enough to pay for that inspection process. But because we can use all of these different varieties of diamonds, Diamond Standard is something that's never existed in the diamond industry, which is we are a natural market maker. Because we can use every type of diamond, we're willing and able to bid for every type of diamond. And that bid is what's in the market term is called actionable. Our bid is cash on the barrelhead, offering for every variety of diamond. In fact, that's about 16 million varieties. Because we are this new type of entity, which is a market maker, we were able to form a new kind of exchange that's never existed in the diamond world, which is an electronic loose diamond exchange. You can read more about it at the website, which is thedse.co. At the Diamond Standard Exchange, we make bids for millions of types of diamonds a day, and we buy about 10,000 diamonds a week through an automated market making process. Right now, we're buying from all the diamond vendors in the world. Right now, we have 150 members with about $10 billion worth of diamond inventory at any given time. As of this week, we have over 1 million diamonds a week being listed on this exchange. And it's through this exchange that we force the market to do what's called price discovery. We bid until we discover the price at which somebody in the world is willing to sell us every type of diamond. We accomplish this process by using automated market making. And this chart gives you a little idea about how it works. Diamond characteristics that drive the price are primarily the carat weight, the color, and the clarity. And I'm sure you've all noticed that as a diamond gets larger, the price of that diamond goes up exponentially. A 110 carat diamond is not 10 times the value of 10 1 carat diamonds, everything else being equal. A 10 carat diamond might be 100 times the value. And the same goes for the clarity. A flawless diamond is worth exponentially more than a non-flawless diamond as they go down the line. A D-colored diamond is worth much, much more than an L-colored diamond, even though your eye may not readily be able to tell the difference. Our system makes a bid for every possible combination of carat weight, color, and clarity on this exchange. We adjust those bids all throughout the week so that at the end of each week, our goal is to buy what's called a statistically valid sample of all 16 million diamonds. Obviously, we don't buy 16 million diamonds, but we do buy about 10,000 in each sample. That sample must contain a little bit of every different type of diamond characteristic, a variety of every carat weight, every color, and every clarity. Imagine a pile like this on a desk of diamonds, 10,000. Those diamonds we make public so that we can prove that we bought a sample that's representative of everything. And you might imagine these statistics of that pile. For example, what's the median? What's the frequency of decolor? What's the average weight of all the flawless diamonds? No matter how you slice that pile, the statistics for that pile are always the same forever. So the sample of diamonds we buy 30 years from now will be statistically identical to the pile we buy this week, even though the diamonds will never be identical. It's impossible to replicate the same 10,000 diamonds, but our breakthrough, which is a computer science breakthrough, is the automated market making and the statistical sampling that allows us to create in aggregate identical sample. By buying that sample, we've proven that we forced the price discovery in the market, and we've acquired the same sample. Now, some people ask, what if D-colored diamonds alone double in value? and everything else stays the same. Doesn't matter, because the frequency of D color that we used last year, this year, and in 30 years, we always use the same frequency of D color. So no matter what happens with those curves, the demand or the value for each type of diamond, our commodity always represents an equivalent sample that never changes. The last step of our process is, now that we have a pile of diamonds, we've created a breakthrough in optimization that divides those diamonds into the coin and bar. One thing you'll notice is this curve. And as you see, the diamonds get larger as they go up the curve. They get more colorless. They get more flawless as they go up that curve. We refer to that as the yield curve for diamonds. And it's not quite the yield curve of bonds, where it's the interest rate, but it's the frequency of those diamonds being yielded from the earth. The frequency of D colors is much lower than the frequency of K color. And that's what creates that increased scarcity. Every coin contains a progression of the yield curve. It's in itself, it's a statistical sample of the entire yield curve. So every bar will contain a mix that's along those curves. Every bar has a mix of carat weight, color, and clarity that always exceeds the public standard, which is the diamond standard. This entire process is regulated. It's supervised by the Bermuda Monetary Authority, and it's also audited by Deloitte. And as a result of the fairness and the transparency and the consistency and the oversight of this process, this commodity has been approved, as a commodity, but also as the good for delivery bar, or the good for delivery coin that can be used to settle futures contracts. And in fact, we're listing a futures contract in the near future on the CME exchange. And we're also listing an option contract on the MIAX options exchange, as well as we have ETFs that we're planning. So now I want to talk to you a little bit about what we see as the investment thesis and the potential demand for diamonds going forward. So diamonds are a very interesting natural resource. Everybody knows about diamonds. Even the pirates from the 1500s, they were trying to plunder diamonds. So diamonds have always been valuable. De Beers obviously increased that value. It made them really a consumer mainstay. But diamonds have always been valuable. And unlike every other precious metal, though, they were always just out of reach to investors. They're attractive, but because you cannot mark to market, as I've mentioned, an investor really couldn't hold diamonds. Because you can never get liquidity, you would basically buy at retail and sell below wholesale. There's no investment opportunity until now. But if you look at diamonds and what the value of the above ground supply is, it turns out that diamonds are, of all the diamonds mined that are in jewelry for the most part, they're worth about $1.2 trillion at today's market prices. 1.2 trillion for a natural hard asset is second only to gold, which is worth about 9 trillion, all the above ground gold in the world. Diamonds are worth more than all of the silver, platinum, palladium, and rhodium combined. And we notice an interesting trend. If you look at any one of these precious metals, investors own at least 15% of that above ground supply. And what I mean by investors, I mean the bars in a vault, the gold coins, the palladium that's asset backing ETF funds and futures contracts. I'm not counting all of the jewelry. That's not an investment. But all of the intentional investment assets are at least 15%. But for diamonds, that number is close between 1% and 2%, we believe, in that What that leaves is what we believe is the pent-up demand. The expectation is that now that you have a fungible diamond commodity that's traded on spot markets, that's being added to the futures exchanges, and with ETFs, as more investors are able to allocate to diamonds as an asset, we think that diamonds will catch up with palladium, meaning that 15% of diamonds will be acquired. We're obviously working to help that process. As you're probably familiar, we launched the Diamond Standard coin in March of 2021. Since then, it's returned about 35% return. This year in 2022, it's returned 6%, which means diamonds have outperformed gold, silver, the S&P, and bonds, which is a very positive outcome. What we've launched most recently is the Diamond Standard Fund, which we'll talk about in a minute, but that basically makes these diamonds into a stock where investors who don't hold commodities, and they can much more easily allocate to diamonds to this fund. I've mentioned the futures and options we have approved, and we have filed an ETF to list on the New York Stock Exchange. That's not been approved, and that'll take some while to be approved. In the future, we're also launching a cryptocurrency, what we call a commodity currency, that can take advantage of diamonds as an asset class. All of these assets over time will allow additional investors to build a position in diamonds as an asset. For example, most people don't hold direct commodities. They prefer to invest through a fund, but a lot of investors can't invest in private funds, like an ETF. It needs to be an ETF before a very large number of investors can build positions. But as the demand for diamonds, as the volume of trading of diamonds increases, they're going to hit an inflection point that I expect to be within 24 months, maybe quite a bit sooner, where diamonds for the very first time get added to the commodity indices. Commodity indices are tracked by tens of thousands of investors who may allocate 5% or 7% to commodities as a category. And what that means is that 5% of a sovereign wealth fund, of an endowment, of a pension, gets allocated to the commodity index. Diamonds will be added to these indices, and that will suddenly create a large inflection of demand. And each of these products, as they launch, will create new demand on a relatively thin amount of diamonds that are liquid and on the market. So the acquisition of diamonds for these different varieties of assets, we think that will drive the price somewhat significantly. So I mentioned that we've launched a fund. That fund is called the Diamond Standard Fund. So you have a choice. You can buy the diamond commodities directly at diamondstandard.co. You'll see they're offered at a market price, which we don't control. That market price is established by market activity. It's, as of yesterday, that index was published on Bloomberg. So if you have a Bloomberg, type DIAMINDX. That is the latest regulator monitored price for Diamond Standard commodities. You'll also see there's a history of that return. Your other option, if you don't want to buy the commodity, is you can invest in the fund. This fund is sponsored by Diamond Standard, and our partner is Horizon Kinetics, which is an $8 billion investment management company. They operate hedge funds and mutual funds and an ETF on the New York Stock Exchange called INFL, which is a very good fund, just launched last year. And together we co-manage the Diamond Standard Fund. The benefit is, by investing in a fund, you allocate to an asset and you don't have to worry about it. There's no custody bills. There's no trading that you have to deal with. It's audited by Witham, which is a tier one, a first class auditor. There's a third party administrator that monitors and gives quarterly reports, but also because commodities are not permitted to be held by most retirement vehicles like an IRA. The fund is the easiest way to invest in diamonds using your investment account. So far, we have 3 RIA firms, wealth management firms, who have allocated to this fund as a convenient vehicle for their investors. So that's the main point. It makes it very convenient to use diamonds as an investment. So let's talk about diamond, some of the technical aspects of diamonds as an investment. What we're starting with is a chart that shows 30 years of price history of silver is white, yellow is gold, red is the S&P 500, and at the bottom, the purple line is diamonds. Obviously, over 20 years, diamonds have been relatively flat, while gold has actually gone up 6.4 times over 20 years. A very large amount of that return, we believe, was caused by the financialization of gold. The gold ETF launched during this period. That enabled a lot more investors to allocate to gold. And gold ETFs are over $120 billion today worldwide. That demand is part of the demand case for gold going up. But it shows you how far diamonds have been left behind because they lacked that financialization. There's a 6x gap over 20 years between diamonds and gold. But that gap is closing. This chart shows you the last 18 months or so of diamonds. And this is since we got the approval to launch the commodity. And you can see it was reported here in the Wall Street Journal. And we've got a front page picture of the markets and investments, business and finance section of the Wall Street Journal. Since then, the Wall Street Journal's covered Diamond Standard 3 times. So it shows you the relevance and how interesting the diamond commodity has been to the financial markets. But over the last 18 months, as I mentioned, diamonds have returned, was 45%. It's come back a little bit in the last month or so. So I think it's 38% or so in total. But diamonds have dramatically outperformed gold, silver, and the S&P over the last 18 months. There's a lot of reasons for that. A large part of it is demand for jewelry during COVID increased. But also during that period, we started buying very substantial amounts of diamonds. You'll notice in December, we got our second regulatory approval, which released the cap. We had a cap on how much commodity we were allowed to sell. That cap got released in December, and we started buying much more significant amounts of diamonds. And you'll see that the trajectory of diamond return increased to about 35% annually. Why would diamonds go up? Well, a big part of it is inflation. And inflation, as you probably know, you may have noticed, inflation is at the highest point that it's been since the early 1980s. Everything is getting more expensive, and commodities have entered what's referred to as a super cycle, where commodities start becoming more expensive. Oil was a big trigger, and then everything that's produced using those commodities becomes more expensive. And a super cycle is usually 10 to 20 years where the prices of commodities are above their long-term moving average. Commodities, by investing in them, which are move up and down with inflation, the commodities provide a hedge where your dollars will lose their purchasing power, but if you invest in commodities, they generally tend to perform better versus inflation. They go up with the inflation. The Goldman Sachs Commodity Index returned 40% last year, which basically matches the return that we observed with diamonds during the same period. Goldman Sachs says the case to own commodities has never been better. If you're an institutional investor, and you may not know my background, I used to run quantitative equities for Tudor Investment Corp, Paul Tudor Jones, and I ran a quantitative equities fund for Millennium, for Izzy Englander. Millennium is now, I think, a $60 billion fund. I only had 500 million to run. Still respectable. But if you're an institutional investor, this slide might be the most interesting to you, because this shows you the correlation historically of diamonds versus every other asset class, most notably precious metals. So the top block shows you 20-year correlation, and the bottom one, and that's a monthly, and the bottom block shows you 2 years of correlation to weekly returns. You need a little more granularity. But what you'll notice, you'll see 11 is diamond across the top row. There's no asset that has more than a 0.17 correlation to diamond. They're absolutely uncorrelated to every other asset class, both long-term and short-term. This is a breakthrough for any kind of portfolio manager, because it means no matter what portfolio you add diamonds to, they reduce the volatility. And since their return is positive, they would also increase the Sharpe ratio of any existing portfolio, because that asset's not correlated. Now, I really want to emphasize the warning. As diamonds become financialized, it's inevitable that they become more correlated, because liquidity correlates everything to some degree. As investors pull money out of the market, a lot of things tend to go down at the same time. We expect that diamonds over the long term will become more correlated to other assets. However, we believe that diamonds are going to go through a 5 to 7 year secular phase of position building. Nobody owns diamonds now. No institutional investors, no ETFs, very few family offices. So for 5 years, there's going to be a demand to fill initial positions. We believe that demand will have the largest impact on price, more than intra-quarter liquidity changes. The way gold changes based on adjustments to existing balances. The balances of diamonds are zero and they're going up. So we think that will keep diamonds from being highly correlated for that phase of position building, which I'm guessing is, like I said, 5 to 7 years. So let's talk a little bit about the characteristics of diamonds, which makes them interesting. Number one, they're the most dense asset in the world. The diamonds that we use in the coins and bars add up to $1.1 million per ounce, compared to gold, which unfortunately was 1900 when I made this chart. Gold is now around 1780, last I looked at it. But because they're so dense in value, the cost to store, to move, to maintain diamonds is a fraction of what it is for gold, and a tiny fraction of what it is for silver. Silver is obviously much larger per dollar. All of our commodities are stored at third-party custodians. In the case of individual investors, it's at Brinks. And if you're an institutional investor, you have the option to custody at JP Morgan. But let's talk about the demand for diamonds. What's caused diamonds to go up almost 40% in the last 2 years? Well, part of it was COVID. During COVID, a lot of the mines were temporarily shut down to prevent outbreaks. Obviously, you're in a close quarters in a mine. They didn't want COVID outbreaks. But during that time, all of the consumers were at home, and a lot of them were still shopping online. They weren't able to travel, go to restaurants, and do a lot of other activities, go to concerts. So a lot of that spending got pushed into jewelry, which increased by 21% during that phase. So fewer diamonds were being mined, and more jewelry was being bought. As a result, prices of diamonds rose, and the supply of diamonds, the inventory of diamonds was reduced. This jewelry demand, this increase in jewelry demand in 2021 continued worldwide. In every major market of the world, US, China, Europe, Asia, India, etc., demand for jewelry increased. This demand is projected to continue to increase. Now, this data was from before some of the current Ukraine and potential recession, but longer term, diamonds are projected to diamond jewelry is expected to increase by 2.5% to 4.5% annually. For Richemont, which owns Cartier, Van Cleef & Arpels, Piaget, and other jewelry companies, analysts expect the consensus is 7.8% annually for the next 5 years. So these levels are estimates, but regardless, it looks like jewelry demand will increase. The problem is the supply is already now at its all-time low. Not all time, but in the last several decades. De Beers and Alrosa, contrary to what a lot of people believe, they don't have excess inventory. They're not sitting on a stockpile that they can sell if the price goes high enough. De Beers is part of Anglo American. They've been public for 20 years, and their inventory is public. It's more often, 9 to 18 months of inventory at any given time. Right now, that inventory is fully depleted to its all-time low. Jewelry demand is going up. Inventories are at an all-time low. We expect those two aspects will have the potential to drive diamond prices up. Longer term, the supply of diamonds has been diminishing consistently. And this is because we haven't discovered a new diamond mine in 25 years. The last mines were discovered in Canada. 2 of those mines have already closed. They only lasted for 6 to 11 years. There have been no new diamond mines found. The existing mines are being depleted fairly rapidly. And in fact, in Australia, they closed their last operating diamond mine. And Australia used to produce about 12% of the diamonds. So longer terms, you have a naturally diminishing supply because the lack of new mines. They may discover a mine that would change things. The one light that has shown up is that they found more diamonds out in the ocean. And if you're familiar with the geology, basically diamond mines are extinct volcanoes that got compressed and created this kimberlite pipe, it's called. And the diamonds are in this pipe. Unlike gold, it's not spread out over a very, very large region. Diamond mines are very concentrated. But what happens over millions of years is that a river might have washed through these pipes and washed the diamonds out to sea. So right now they just launched the 5th ship that's owned by De Beers in Namibia, the country, where they're scraping the seabed to dig up diamonds. That's kind of worth one mine, basically, is the amount that they're producing. More recently, there's been a supply shock because around 30% of the world's diamonds by carat weight, not by value necessarily. These are generally lower quality diamonds, but about 30% of diamonds are produced in Russia. And because of the invasion of Ukraine, Russia has been sanctioned. We can't buy any diamonds, nor can any American or European jewelry company. We can't buy diamonds from any Russian source. We can't pay anything through the Russian banking system. And so that's significantly depleted the supply of rough diamonds. Now, rough diamonds take a while to work through the polishing, the cutting, the sales by the vendors, but that's really starting to impact the market now. And we see in India that tens of thousands of diamond cutters have been laid off recently because of they don't have any diamonds to cut. So the last thing I want to mention is, I think something very interesting about diamonds as a category is that this is a very, very positive ESG investment. Diamonds are a natural resource, but they're mined in a way that is not very damaging. There's no chemicals used in diamond mining the way there is for copper and gold, all those acids. They basically dig up rock and crush it. Diamonds are also very dense value, so the transportation, the storage are very, very efficient. There's a lot of small mines and small vendors in the diamond industry. Diamond Standard buys diamonds globally. We pick them up in Thailand, in India. So we provided a level playing field for small vendors to sell us their diamonds. They don't need to be a large international company. We also provided governance because we're regulated. We do KYC and AML, and all of the vendors of our exchange, they sign an agreement that mandates no child labor, no unfair practices, no, all kinds of governance and social benefits. But I think longer term, the largest benefit of Diamond Standard is we need to buy our diamonds over the long term from consumers. We're going to create a dividend to society where we buy back all of the non-productive assets that are owned, we estimate, by 1 billion households around the world. Everyone whose great aunt died and had an engagement ring, all the tiaras of old Europe, all of the divorcees, all of the jewelry that was bought in the 80s and is out of style, we want to buy it back. And we, unlike a pawn shop, we don't have a cost of sales where we need to market it and have a retail front. We can pay a lot more for consumer jewelry. And over time, as diamond prices go up, inevitably, I bet that we buy diamonds back for more than anybody paid for them. So that's a huge, huge social benefit of putting money into the pockets of consumers and letting them use that asset much, much, much more productively. So that's the last thing. If you're interested in learning more about Diamond Standard, you can visit diamondstandard.co. You can download this presentation, which goes to the investment case, how we make the commodity. I didn't mention, and I will mention it now. I'll give you a quick overview of how the commodity works. As I mentioned at the beginning, there's a coin in a bar. The diamonds are inside, so this is the asset. But also inside, if you can see that white layer, which you can see from the back, that's a wireless computer chip that's built into the coin and bar. That computer chip does 3 interesting things. Number one, it provides auditing. So while your asset is at Brinks, you can audit it and it will answer, yes, I'm here. Also, that chip provides authentication. If you don't have it in Brinks, but you have it in your home and you want to sell it, the person you're selling it to, they can authenticate the coin or bar just using their normal phone. Their phone interacts with that chip and their phone takes an image of the coin and bar, and you can see there's a unique pattern for the diamonds, and there's also these little purple spots that are randomized. It's a fingerprint. But the most important feature of that chip is that it stores a blockchain token. That token is essentially a vault receipt, that when the bar is delivered to the vault, that token is activated and the owner is holding it. Whoever owns that token owns the bar. They can redeem the bar at any time. That token is regulator licensed, which means it's regulator approved settlement. In fact, for the CME, we deliver the tokens to the futures broker, and that settles the futures contracts. When you trade a coin and bar, which is coming this month to diamondstandard.co. We'll have the spot market open, which is a peer-to-peer marketplace. You're actually trading the token. The bars never move. They're sitting in Brinks. This token is a huge breakthrough because it makes an asset that's both physical and digital. It's physical in my hand, but it's also digital as a regulator-approved token that you can trade. It's the only asset in the world that's both physical and digital. What that means is you have an asset that is extremely efficient to transact, but that same token transfers and transforms the physical commodity into a fund asset, into a futures contract deliverable, into an ETF, and coming soon into a digital currency, a commodity currency. So all of these assets are using the same token as the underlying transaction medium. And this creates a network effect where if there's demand anywhere in this universe of asset types, that demand is reflected throughout the network. That if the price is too high in the ETF, people will sell the ETF and buy the commodity. And it can move with very, very low friction, very, very low costs. So that's the Diamond Standard overview of everything we've built. So anyway, that's the last thing I'm going to mention. And if you want more information, diamondstandard.co, email hello@diamondstandard.co. If you're interested in the fund, you can visit fund.diamondstandard.co. And with that, I want to turn it over, ask Chris if there's any questions.
We've got 136 attendees that are offering words of support and thanks, but there are no questions.
No questions?
No questions.
That means I did a perfect job of explaining everything.
There's a lot of people lurking
so that's,
and learning.
That's kudos to me. Perfect explanation. Okay, last chance. Any questions? Be happy to answer.
Endorsement says, thank you, Cormac. Very informative. Rex Johnson says, hi, this is great. Ali Khan said, very nice, but no questions.
Great. Okay. Well, thank you very much. Thank you very much, everyone, for participating. And please contact us if you need any help. Thank you.